Good afternoon, everyone. Welcome you all to this important webinar on valuation key aspects under IBC Act, IBC procedures. Friends, we have two renowned speakers in the different areas. One valuation and one is insolvency expert. We have with us here Alok Saxena, a well-known insolvency professional. Alok ji in practice for more than 30 years, has been in tax and company law matters, FEMA matters. He's a regular speaker in the ICAI programs. Especially we have been taking benefit of his services in WIRC for many years. He had been a regular contributor also to the publications, especially from WIRC. We have seen it. We also have C.A. Drishti Desai, a chartered accountant, renowned chartered accountant, an expert in valuation. She is a registered valuer and renowned registered valuer, I must say, especially because of the current developments which she has, assignments which she has handled. She has been also a speaker and a contributor in this area for the Institute. More than that, she was also a regional council member for 2 terms and being a vice chairperson of WIRC in the last year only. So I welcome both the faculties to this program. We also have with us C.A. Durgesh Kabra, who is a chairman of Committee on Insolvency and Bankruptcy Code, and also, of course, chairman of FRRB and convener of Center for Audit Quality. Welcome Durgesh ji also, and vice chairpersons of these committees are also here. Sri Priya Kumar, vice chairperson of Committee for Insolvency and Bankruptcy Code, and Kotha Srinivas, CA Kotha Srinivas, who is a vice chairman of Valuation Standard Board. So welcome you all, welcome all the participants, and let me tell you, first of all, acknowledge the office also for excellent arrangement of faculties and the program. In fact, timely arrangement of this program for the benefit of membership at large. As we all know, friends, valuation has been a developing area of practice. Rather, one can now say a developed area of practice. And registered valuers play a very significant role in the insolvency areas also, insolvency and bankruptcy related areas also. Now, registered valuers' importance has been underlined by the mandatory appointment of 2 registered valuers. And therefore, the valuation and insolvency, one can say, go hand in hand. And there are a lot of issues which valuers face, a lot of issues which insolvency professional also face. And one has to understand the interplay of it, or that is the relationship amongst both these professionals. And for this, I think the importance of this session is very much there. As we all know that for the finding out the correct value, insolvency proceedings, finding out the valuation of assets, it is mandatory to appoint a registered valuers. And registered valuers, the Institute of Chartered Accountants of India, in order to bring the standardization in this valuation, the valuation standards have been devised by the Institute of Chartered Accountants of India. And the Valuation Standard Board is a board which looks after the implementations and the formulations of the valuation standards. We at Valuation Standard Board, along with the Committee for Insolvency and Bankruptcy Code, are organizing this program to tackle the issues of valuation as well as insolvency and how it can be correlated. And therefore, these 2 professionals are there to guide us on this topic. As far as valuation is concerned, asset classes have different parameters of valuation. In Insolvency Code also, there are certain regulations and sections. For example, Regulation 27, 35, Section 46, which has a direct correlation with the valuation. So how these sections, how these provisions play important role, how the valuers have to, and the insolvency professionals have to act hand in hand as regards the valuation process is concerned, so that the committee of creditors is much assured about the valuation of the assets. Let's try and evolve this and understand this from the 2 eminent faculties. So I welcome you all once again for this session, and I also request Durgesh ji to enlighten us about his views on this session as well as procedures at large. Thank you very much and welcome you all once again.
Thank you.
Over to you.
Thank you, dear CA Mangesh Kinare, the council colleague, and immediate past vice chairperson of the WARC, Drishti Desai, who is the speaker today, panelist today, and the Alok Saxena ji, and in absentia Sri Priya ji and Ota Srinivas ji, for this wonderful webinar which is being organized by CIBC and Valuation Board of ICAI. I welcome all the members to join this virtual CPE meetings, which is on the valuation key aspect under IBC 2016. And let me tell you, friend, as is told by Mangesh Kinare, it is very important to understand the intricacies in case of the insolvency where valuation is being asked at least twice. So friends, to resolve all those doubts in your mind, we have two speakers today, the panelists today, Alok Saxena ji, who is the insolvency professional, and Drishti Desai, who is the registered valuer. Friends, as you all know, that the Insolvency and Bankruptcy Code 2016 is considered as one of the major historic reform being brought in country, and this is laying down the foundation for market-led and time-bound insolvency resolution framework. As we all know that IBC has opened up various professional opportunities and avenues for the chartered accountants, besides being an interim resolution professional, liquidator, bankruptcy trustee. Member can also work on other professional avenues under the code, and one such important area is as toward the registered valuer for valuation purpose under the IBC. And friends, the code also brings about the importance of valuation under IBC required under various processes prescribed by the code, such as corporate insolvency resolution process, liquidation process, voluntary liquidation process, and prepackaged insolvency resolution process. Let us take an example of CIRP, where the resolution professional shall appoint two registered valuer to determine the fair value and the liquidation value of corporate debtor, and where under liquidation process, the liquidator is of the opinion that the fresh valuation is required, he or she shall appoint two registered valuers to determine the realizable value of the assets or businesses of the corporate debtor. Similarly, under the pre-packaged insolvency resolution process, the resolution professional is required to appoint two registered valuers again to determine the fair value and the liquidation value of the corporate debtor. While conducting the VCM virtual CPE meeting last year on the case studies of United Seamless Tabular resolution under IBC as a part of case study series organized by the committee on successful resolution cases under the IBC, we had discussed a landmark judgment of the apex court in the Maharashtra Seamless case, wherein the Honorable Supreme Court has held that the code doesn't mandate that resolution plan amount should necessarily be more than the liquidation value. It becomes very important to understand the role and significance of valuation under the IBC, and also to understand the important issues while performing the valuation engagement under the IBC. So I think the deliberation which are going to be taken today and the issues which are going to be discussed today by these two panelists, one is the insolvency professional and other one is the registered valuer. I'm sure that this VCM will surely and certainly help in building the capacity of insolvency professional as well as the resolution professional. Also will try to resolve the various issues with respect to the valuation while the corporate debtor is under the insolvency. I must compliment and thank both the secretary, both the lady at helm of affairs of the committee, Sarika and Rita. Both have done wonderfully good job for this particular event. Though it was a very short notice, but they did a lot of efforts, and ultimately we could find best of the faculties, and they are there for all the professional brothers and sisters who have joined here, and I'm sure these all members will get benefit of this. Thank you all for giving me patient listening, and I wish that this session will be of very much use for all the members who have attended this particular session. Thank you very much.
Thank you, Durgesh, for your insights, the insolvency aspects, and giving the good words for this program. Yes, certainly the office has done a great job and conceptualizing this aspect also. So I think now we'll start with the first presentation, first part of presentation, which will be done by, I think, Drushti. Drushti is doing that first. Sorry, can you?
Yes. Sir, Alok sir.
Alok sir is doing, yeah. Alok sir ji, Alok ji. Alok sir. Alok Saxena ji. Alok bhai.
Durgesh, can you hear me?
Yeah.
Yes, Saxena ji, we can hear you.
Okay.
We can hear you.
I thought I'm going to speak later on, but it's okay. I'll just share the screen. Yeah.
Still the same thing, Alok ji. We couldn't see your face.
Okay.
Can't see your face.
See, first thing you will see my face.
Yes.
Yeah.
Hello.
Hello. Yes.
Hello.
So Alok ji, you can start the opening batsman as an opening batsman. Then from the insolvency aspects, and then
I'm just starting the sharing of the screen, but I'm having some issue. So I'll just take 1 minute. I'm having some system problem.
Share content you might be seeing over there.
Yeah, I can see. I've shared many times, but today this Apple is giving some share screen problem. But I will just solve it. 2 minutes. Some system. See, when you reboot the computer, you update your thing, something or the other.
Have you logged in from two systems by any chance?
I've asked my assistant. I'm just logging out. And I'm just coming in from the other computer. Just give me a minute. Thank you.
Yeah. Yes, we can see the screen now.
Alok ji.
आलोक जी अभी दूसरे कंप्यूटर से आ रहे हैं.
हाँ, बराबर. That is fine.
You can see it now.
You can start, Alok ji.
Yeah, you can see the screen.
Yeah, we can see the screen. You can start the presentation. And
Very
so that,
good. Sorry to keep you.
Yeah.
Sorry to keep you waiting because I detected some system error in that. Okay. So,
no issue. You can
friends,
start.
we are. I am grateful to Mangesh ji and Durgesh ji, Rita ji for giving me this opportunity to show you a presentation of valuation, which is a key aspect under the IBC. As you see that valuation, improper valuation can lead to disastrous consequences. And but at the same time, anybody can ask this question, what is the perfect valuation? I've also been trying to find a solution to this issue of what actually is the perfect valuation, and actually there is no reply to that. So ultimately, we have to come at a figure which probably looks good. So for that reason, our IBBI regulations provide for two valuers. Now, uh, this is extremely important to note that valuation as an exercise is an exercise where it will always be an estimate under the circumstances. And based on that, the valuers would take into account a lot of factual data which has to be provided to them, which of course Drishti would cover. The correct valuation can only be got if the data is given properly to the valuers. All the documents are given properly to the valuers. The circumstances are given explained properly to the valuers. Otherwise, 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 it is very difficult for the valuers to give a correct estimate of the valuation. I would say this because in my limited experience of last 5 years, we've done a good number of cases. I have found that valuation uh, is always hedging on a lot of facts of the case and the documents and the circumstances. And I saw that where things were not provided properly, the valuation uh, went for a toss. And I have seen one particular case. I'll name that case Seven Hills Hospital. Now, in that case, very interestingly, there was no lease of this property. It was not even executed between BMC and Seven Hills Company. Now, Seven Hills Hospital, when it was being sold, the valuation, this is all there in the Supreme Court order. So I'm borrowing all that from what I've read. Now, and I know this case intricately because I was involved in some way in this case. When they did the valuation, this very important point that the asset of the corporate debtor is not to be, which is not owned by the corporate debtor, should not be taken into account. But once a lease, uh, if you don't have a lease on the land, but you have a building standing on it, what do you do? Do you only value only the building, which ought to have been the case eventually what Supreme Court said? You have no right. But if it's a going business and there is a land on which it stands, probably you don't have a proper document of it. Now, in this instance case, the valuation which was done apparently took into account the availability of lease, that the lease would ultimately get available to it. Now, such a huge assumption actually worked against it, because when you see the road which Seven Hills traveled, ultimately Bombay Municipal Corporation took this case before the Honorable Supreme Court, who then adjudicated this matter and said, no, there is no lease, and this cannot be part of the resolution. When you don't own the land and the lease, you cannot deal with it. That had a fatal blow. And even as on today, it is one of the earliest cases which was admitted, and it was valued at about 1,000 crore plus. The values collapsed, and until today, the resolution has not taken place. So such is the importance of valuation that we see. Now, I'm going to my first slide. What is the need for valuation? The spirit of any CIRP is to first try to revive the corporate debtor, and if that is not possible, then to wind up the company. IP is supposed to provide two sets of value. One is fair value and second is liquidation value. Fair value guides the action of RP and COC For resolving the debt of the CD, fair value becomes important factor for acceptance and rejection of the resolution plan. I must add here that the liquidation value also plays a very important role in deciding about the acceptance or rejection of the plan. Therefore, valuation is a very important aspect in a resolution of the plan. Therefore, I may say that a lot of attention has to be given by the RPs in arriving at the fair value and the liquidation value. And as I've mentioned in the opening remarks, that these values are always estimates, and it is always very challenging of what would be the value, especially considering that we have a huge amount of debt standing along with interest, and you could well imagine that the value which could be arrived at could be a very insignificant part or very low to the total outstanding, and it poses a lot of challenge. So for value, arriving at a value is one of the very important aspect of the resolution process. And then the last point, liquidation value is also important to the liquidator when the company goes into liquidation, and the SEC for liquidation of corporate debtor. LV becomes important factor for determining the reserve price in liquidation. Again, I have listed out the significance of accurate valuation. Overvaluation may result in rejection of the resolution plan and liquidation of the corporate debtor. Undervaluation may result in gain to the resolution applicant and promoters, and not promoters actually, we should delete this, to the resolution applicants, and lesser realization for financial creditors and operational creditors. The difference in facts between two valuation report can lead to litigation. Very important point which I had mentioned in my opening remarks, that we should give both the valuers the same sets of facts, and their reports, their draft reports should definitely be seen by the RP to the extent not to influence the valuation, but to see that the facts which they are narrating, that they have got all the correct facts. Otherwise, you would have two different valuation, and this can lead to litigation. For valuation requirement under IBC, we have section for CIRP, we have section 27 and 35, regulation 27 and 35 of the IBBI insolvency resolution process for corporate person. We refer it to the CIRP process. For liquidation, we have section regulation 35 of the liquidation process. For fast track CIRP, we have regulation 26 and 34. For voluntary liquidation, we have section 59 3B2 of the insolvency code. For individual bankruptcy under regulation 30 of the IBBI personal guarantors insolvency, we have regulation 30. So these are the basic framework under which the valuations are required to be conducted by the RP. He has to appoint valuers, and let us see what this regulation says to understand what exactly the CIRP requires the RP and the valuers to do, and also during the liquidation, what is required of the RP and the valuers. Now, looking at it, there are two more definitions of fair value and liquidation value under the CIRP, which we need to just see. So, this is regulation 21HB of CIRP regulations. Fair value means the estimated realizable value of the assets of the corporate debtor if they were to be exchanged on the insolvency commencement date between a willing buyer and willing seller in an arm's length transaction after proper marketing and where parties had acted knowledgeably, prudently, and without compulsion. So the value which will come out would be the fair value between what a willing buyer and willing seller is ready to pay. Again, this becomes very challenging because a willing buyer, willing seller concept is a concept which could change between what the buyer is looking at. Seller is put his goods to sell, but how the buyer sees. So the fair value generally, which is taken into account, it takes in all the facts of the case and is generally the estimated market value of if it's a running company as a going concern. So you can say that is one of the methodologies with Dishti will deal with in her presentation. These would be values which one would pay on an as it whereas basis, on a going concern basis. And if the unit is not working, then the fair value would be estimated on the market value basis. Then we have the liquidation value under regulation 21K of the CRP regulation. Liquidation value means the estimated realizable value of the assets of the corporate debtor if the corporate debtor were to be liquidated on the insolvency commencement date. Now, in this case, the valuers have to assume that there is no resolution. And supposing there is no resolution and this company were to go in for liquidation, what it could realize, and here we use the word realizable value, would be the value which is not of a going concern, but of a situation where this unit is stopped and you have to sell it on as it whereas basis in a closed condition. Of course, when we'll see the liquidation regulation, one of the ways to sell during liquidation is also as a going concern. In that case, we may not rely upon the liquidation value. We would rely upon the fair value of a going concern. But and we could rely upon that value for selling the assets. But the liquidation value would generally mean a case where this company is no longer a going concern and it is supposed to be liquidated in it is going to be liquidated and sold after knocking down the assets. So in that case, the liquidation value generally is far lower than the fair value. So with these two concepts which are used, the valuers then give, we have to appoint two valuers and both the valuers give two values. One is the fair value of the unit and the liquidation value of the unit. I must admit, where the unit is close, probably the fair value and the liquidation value would be very close, but he can have different parameters for doing a fair value. So there are many techniques even in a closed unit to arrive at a fair value. So, but a liquidation value would be then the knockdown condition of the plant. So we would have two valuers who would give the fair value and the liquidation value. We are supposed to take the average of the values, of fair values and the liquidation value to come to the average value, which is then considered by the COC in their various tasks which are assigned to them for resolving the debt of the of the corporate debtor. Now we look at section 27 and 35 of the CIRP process. Now, I'll only read the important paras. Regulation 27 of the CIRP. The resolution professional shall within 7 days of his appointment, but not later than 47 days from the insolvency commencement date, appoint two registered valuers to determine the fair value and the liquidation value of the corporate debtor in accordance with Regulation 35. This is what we had said, that there will be two valuers which will be appointed within 7 days and not later than 47th day. Now, there cannot be a delay in appointing the valuers, because if you delay the process of appointment of valuers, then the entire process will get delayed. Now, one of the questions which has been always agitating the mind is that initially you have an IRP and then you have the RP. Now, the RP gets confirmed, the IRP gets confirmed within 30 days after the insolvency commencement date, when he calls the COC meeting and then he's confirmed or not confirmed. The dilemma is always on the IRP, whether he should appoint the valuers or he should not appoint the valuers, considering that 47 days have been given to him to appoint. This is a very practical problem, and in my opinion, the resolution professional should, the IRP should take all steps to appoint the valuers within this timeline which has been prescribed. And in many of the cases where the IRP had failed to appoint in proceedings before the IBBI, in disciplinary proceeding before the IBBI, this was held against the IRP that he did not fulfill his duty of appointing the valuers between 7 and 47 day. Because this is a very practical problem, because when the IRP is not confirmed, there are cases where his fees, the remuneration which he fixes for the valuers, is then disputed or is not approved, and it puts a lot of pressure on the IRP as to why he has done this. So he becomes a little cautious in doing this work, but in my opinion that he should go ahead and appoint them and place everything before the COC, and it is for them to deal with it later on, but he should do his duties. The second point in section regulation 27 is the IRP or the resolution professional, as the case may be, may appoint any other professional. This is not in addition to registered values. This is not the point which I would, this is not relevant to our discussion today. Then we go to the next slide where we see now who should be the person who should be appointed. Provided the following person shall not be appointed, namely a relative of the resolution professional, a related party of the corporate debtor, an auditor of the corporate debtor, that's not relevant, a partner or director of the insolvency professional entity in which the resolution professional is a partner or director. So these are the limitations on who should be the valuers. He cannot be a relative of the RP. He cannot be a related party of the corporate debtor. He cannot be a partner or director of the insolvency professional entity in which the RP is a partner or director. So there are some restrictions on the persons to be appointed as valuers. Now coming to regulation 35 of the CIRP regulation process, fair value and liquidation value shall be determined in the following manner. The two registered valuers appointed under regulation 27 shall submit to the resolution professional an estimate of the, see the word used is estimate. As I said, there's no perfect value, it will always be an estimate. An estimate of the fair value and of the liquidation value computed in accordance with internationally accepted valuation standards after physical verification of the inventory and fixed assets of the corporate debt. Point number B, if in the opinion of the resolution professional, the two estimates of the value are significantly different, he may appoint another registered valuer who shall submit an estimate of the value computed in the same manner. And C, the average of the two closest estimates of the value shall be considered the fair value or the liquidation value as the case may be. So if you look at Regulation 35, it provides a mechanism where you will get two estimates which are quite close to each other. Therefore, if you look at para B, if again I'm reading para B, if in the opinion of the resolution professional, the two estimates of a value are significantly different, he may appoint another registered value. Now, what is significantly different? Significantly different is not defined, but what we say is if the difference is more than 25% between these two valuation, or he may consider significantly different even at a different percentage, and then but generally if it is more than 25%, we consider them to be significantly different, and then there is a need to appoint a third valuer. And when the third valuer is appointed, you will have three different valuations, and the two closest estimate of the values to each would be considered as the fair value or liquidation value. So I think this is quite understandable. How do you come to the two out of the three? The one who are the closest to each other will have to be taken. Coming to para 3 of Regulation 35, the RP and registered valuers shall maintain confidentiality of the fair value and liquidation value. Now, this is again a very, very important aspect in the resolution process, because these values are going to be shared with bankers, because they are entitled to these values, these fair value and the liquidation value at the time, at a particular time during the CIRP process. That is the time when the resolution plans are circulated. We have to share these valuations with the secured creditors and the members of the COC. These values have to be kept confidential, and if these are not kept confidential, there can be consequences. I may just point out that there has been a recent case of Videocon, where there was Videocon International, where there was a figure of 2,500 odd as the uh, value, liquidation value, which is again seen from the orders. And then they found that the resolution plan was almost close or identical to this value. They have questioned this issue in the order, although they approved the resolution plan of Videocon International, but they have raised some issues on the confidentiality of these fair value and liquidation value. I may point out that RP is not to be only blamed for this. RP generally do not share. They take a confidential undertaking and they give the values. This value might have gone from any other source, but the entire burden of blame comes on the RP. So therefore, this is one clause which always poses some problem to the RP. And going ahead, I think we need to see how we can be insulated from this uh, confidentiality of fair value and the liquidation value. So going ahead, I'm still on now. We also will look at the same time the liquidation process where valuation is required. Now, I've dealt with the CIRP provisions, that how the valuation is relevant and how it is to be arrived at. Now, look at the liquidation process. As you know, if the company during the CIRP process doesn't find a good resolution plan, and or the plan which is submitted are defeated and the plans submitted are not approved, or we don't have any resolution plan, or the COC may decide to liquidate the company, then we enter the arena of liquidation. And in liquidation, again there is the issue of valuation. Now there we look at regulation 35 of the liquidation process. Now there is a provision, now we will see, that you can adopt the same valuation which you did during the CIRP. There is no need to adopt another value. Now let us see regulation 35 of the liquidation process, where the valuation has been conducted under regulation 35 of the IBBI. See, we have the same regulation, so don't please confuse. And please note that regulation 35 of the liquidation process also refers to regulation 35 of the IBBI resolution process for corporate person, that is the CIRP process. The regulation number may be same, but the provisions are different. In 35 of the CIRP, we saw how the valuation is to be arrived at. And here we are referring to those regulations where the valuation has been conducted under regulation 35 of the CIRP or regulation 34 of the IBBI fast track process. As the case may be, the liquidator may consider the average of the estimates of the values arrived under those provisions for the purpose of valuation under these regulations. Therefore, there is a provision that you don't need to redo the valuation. In my own case of Gujarat Foils Limited, I may mention that I did not find the need to, we had done the valuation during the CRP process, and when the company went into liquidation, I did not find the need to do a revaluation. The simple reason is that we found that the liquidation value which was given during the time of CIRP was quite intact, and there was not much of erosion, although 3 years had passed. And I'm happy to say that we ultimately, in a public auction, we could sell the corporate debtor as a going concern, and we realized almost 95% of the liquidation value, the value having been done later on, done earlier during the CIRP process. So the point is that it is a call which the liquidator has to take and see the situation whether you need to do the valuation or not. In another case of mine, I had to do the valuation because considerable time had passed and the values had deteriorated. So in that case, I had appointed fresh valuers. So this is the call which the liquidator only has to take. There is no CI, there is no COC, there is no stakeholders consultative committee which is guiding him on this valuation issue. And this is the call entirely at the table of the liquidator. In cases not covered under regulation 1, sub-regulation 1, or where the liquidator is of the opinion. See, not covered under sub-regulation 1 means supposing the company goes, valuation has not been done at all. That could be a case under sub-regulation 1, or where the liquidator is of the opinion that fresh valuation is required under the circumstances, he shall within 7 days of the liquidation commencement date appoint 2 registered valuers to determine the realizable value of the assets or business under clause A to F of regulation 32 of the corporate debtor. We are going to see regulation 32 because that calls for a different type of valuation, and that is a challenge, because once we see regulation 32 of the liquidation process and then compare it with the CIRP valuation, we will see something different. So let me just go ahead a little bit. Regulation 35 is continued, provided the following person shall not be appointed, that we have discussed. The same disqualifications are there. The average of the 2 estimates under regulation 30, under sub-regulation 3 shall be taken as the value. So the average estimates will be taken. But here there is no need for appointing 3. It may be noted as no need for appointing a 3rd valuer in case there is any difference in the circumstance, in the estimates, that if there are significant differences, also the 2 estimates have to be taken. There is no need for 3rd value in this case. Now I'll just show you, I refer to regulation 32 because there is a challenge and there's a change. Yeah. Now, if you see Regulation 32 of the liquidation process, the liquidator may sell an assets on a standalone basis, the assets in a slump sale, a set of assets collectively, the assets in parcels, the corporate data as a going concern, the business of the corporate data as a going concern. Now, there are 6 ways the liquidator can sell. Now, what have you done during CIRP? You are entitled to adopt those values of the liquidation value done during CIRP without getting into a fresh valuation. But look at the options available to the liquidator. He can sell the assets on a standalone basis, means piece by piece, assets on a slump sale, a sets of assets collectively, some assets together, some not assets together, the assets in parcels, the CD as a going concern, the business of the corporate data as a going concern, that is, you sell the unit itself. So if you look at it, you have 6 options to sell. So a question would be, is relevantly or is very relevant in the circumstances, is that the valuation which is done during the CIRP process, is the fair value, as I said, of the CD as a going concern, because that is what the fair value they have said of a willing buyer and a willing seller to buy the company as a whole. So that is probably what is in E here, but that is the fair value. Now we are dealing with liquidation value which has been arrived at during CIRP. Now how does it fit here? So if you ask me, this certainly does not fit the circumstances which are listed here from A to F. Therefore, the liquidator should actually look into the unit again, see all his options, and then look to get the valuation, liquidation value done by 2 valuers, taking into account some of the circumstances which he can envisage. Let us say if he envisages the sale of one of the assets on standalone basis, also the sale of the unit in F as a going concern, the CD as a going concern. So he probably could get 3 different values at the time of liquidation. And therefore, the valuation done at the time of CRP may not be entirely acceptable or adoptable during the liquidation. Therefore, it is although said that you can adopt it, but the option is entirely at the discretion of the liquidator, and the liquidator may adopt any of these 6, any of the circumstances, and get multiple type of valuations from the liquidator. And of course, he would also have to pay a heavy price to get different types of valuation. So this is where the changes happen when the company is in CIRP and then goes into liquidation. How much time do I have, Rita ji? How much time do I have still? Mangesh ji, Rita ji?
Yes, sir.
How much time do I have still?
Sir, 10 minutes?
10 minutes?
Yeah. Less than 10 minutes I have to finish. Yeah.
Yes, sir.
Okay. I would also see, I'll also just go through Regulation 32A of the liquidation regulations. What it says that when the COC has recommended the sale under clause E and F of Regulation 32 of the liquidation process, that is when the COC is thinking of selling the corporate debtor as a going concern, or sale of the unit or the assets as a going concern under E and F, which we saw earlier, or whether liquidators of the opinion that sale under clause E or F of regulation 32 shall maximize the value of the corporate debtor, he shall endeavor to first sell under the said clauses. So these are the procedural aspect what he should do. So he should try to definitely get a valuation of the company as a going concern, company of the CD as a going concern, of the business as a going concern. See, there's a difference between 32E and F. 32E talks about only the corporate debtor, selling the entire corporate debtor as a going concern, where you just do what you have done in a resolution situation. You sell the entire corporate debtor, which is a new concept under the IBC. You, like I sold Gujarat Foils in the auction, the entire corporate debtor. So they take over the entire corporate debtor and then ask for reliefs and concession, which are like resolution type. Or in 32F, where you sell only the unit, where I don't give away the corporate debtor, that is Gujarat Foils will be with me, but I sell the manufacturer unit only to the bidder. So that would be under 32F. So 32F. So these would be the first options, and that is why the liquidator should certainly get the valuation of in these two situations, because that is the first option available to him. But if the unit is closed, probably this may not apply, and then he can ignore these things. But otherwise, if it's a running company, then he should definitely get this during the liquidation situation, the values of as a going concern. Okay. So I'll just take through, I think Durgesh Kabra ji mentioned about this very important case of Maharashtra Seamless Limited versus Padmanabhan Venkatesh and others. This is a Supreme Court order. Now, always whenever CRP processes were going on, it was always felt that a resolution plan should not be approved which is lower than the liquidation value. So as I said, there is a fair value, there is a liquidation value. So it was always felt that the resolution plan should not be approved which offers less than the liquidation value. And that is where we have this very important judgment of Maharashtra Seamless, which said, Honorable Supreme Court has stated that the object behind prescribing valuation process is to assist the COC to take decision on the resolution plan properly. Once the resolution plan is approved by the COC, the statutory mandate on the adjudicating authority under section 31(1) of the code is to ascertain that a resolution plan meets the requirement of subsection 2 and 4 of section 30 thereof. Honorable Supreme Court approved the resolution plan, which is already approved by the COC, having resolution amount below the liquidation value of the corporate debtor. So here is the case of Maharashtra Seamless, which has said that giving these values is not binding on the COC. Of course, it is a guide to the COC, but if they approve a plan which is lower than the liquidation plan and far lower than the fair value, I suppose, then such a plan also is a good plan and does not require any interference from the NCLT, the adjudicating authority, or NCLAT, and it can be approved. There are more judgments. I had referred to Videocon case as far as valuation is concerned. There have been a couple of cases where the liquidation value and the fair value has been challenged by the promoters. But I must say that most of the judgments have upheld or stood by the valuations done by the valuers and have been and the RP has not been faulted in any way. But there have been some cases, there have been few, I must say, by far very few cases where valuations have been commented upon and set aside, and fresh valuations have been ordered. But again, as I mentioned in the opening remark, where the facts have been properly provided, it is probably because the facts have not been considered in the proper perspective, or the facts have not been provided to the valuers. Because most of the cases where I have seen where the adjudicating authority felt that the valuation was not proper, they have highlighted certain glaring factual inadequacies which were not considered by the valuers. Therefore, I come back to my opening remark and said that the facts of the case and the documents should be accurately and adequately provided to the valuers to do their job. I think I've covered this task which has been given to me for the CIRP process and the liquidation process. What is the importance of valuation and how the valuation affects the liquidation and the CIRP process? Thank you for your patient hearing. Over to you, Rita or Sarika.
Thank you so much, sir. Thank you so much for your presentation. We would now request Drushti ma'am to please make your presentation and share your perspective with us. Over to you, ma'am.
Sure, Rita ji. And first of all, thank you, Alok ji, for this wonderful and very, I would say, a very well covered, overview of the valuation requirements under IBC. The law relating to valuation. I think the way you have elaborated was really very, very nice, and it lays a wonderful platform for me to start off as a valuation technician, as to how one can go about. There is a little bit of overlap in what I have in my presentation, because obviously everything will revolve around the same provisions which are there in the code. But I'll try not to, reiterate what has already been discussed, and I'll elaborate more on the technical parts of valuation. So let me just share my screen. Just give me a moment. Okay. So I think you can see my screen, right?
Yes, ma'am. Yes, ma'am.
Okay, perfect. So as what we discussed till now with Alok ji, as to what are the provisions of CIRP and the liquidation process, which require valuation to be carried out, and how many valuers need to be appointed or not. Let me just throw my perspective on this. So I would say that valuation, as I think he started off with this, that valuation is a very, very important limb in this entire process, because everything is a process of the entire code and the legislative intent of the insolvency code. I think we come to this conclusion that the sole purpose of this IBC and the regulations which have been laid under that is to really maximize the value of the corporate debtor. So that the lenders can really get something out of the debtor, and otherwise it's a national loss. That's one thing that we have to understand very clearly. Also that one can have many legal arguments. In fact, the case of Seven Hills I found very interesting, because when we look at any presumption or assumption for valuation, when we are looking at a going concern valuation, there are obviously many assumptions which go into it. A going concern means there are so many licenses and so many leases, everything, there would be a presumption that it's going to be renewed, but that doesn't fasten that I would not say it will be binding on the authority to renew it. It's only a presumption. And without that presumption, to have a going concern is impossible as a valuer. And so, which will mean that one would be driven to only a liquidation piecemeal valuation, which I'm sure is not the intent of the legislation. Clearly, this was a very early decision, and as I can see the law and the judgments as they have been flowing under this law, I can see that there will be a little more clarity which will be thrown on this this entire process of valuation under this regulation, and we'll come closer to the commercial way of valuing the businesses and the assets under this regulation also, because today we know that there are so many cases where you have value which is hardly a year back, a value, some one tenth the value would be the value at which the business or the shares would be acquired, and then maybe after just a year you see the asset grow to 10 times the value at which it was acquired. So it is not that the value is acquired after the acquisition. The value was the inherent value which was there in the asset, but somewhere in the process and the legal framework, somewhere the value is lost, and in the process it's a national loss. It's not to be seen just as a tick box. It is a very important aspect. Valuation is a very important aspect, and I think the law should settle at a much more commercial level going forward. So this is the process where the objective is obviously to maximize the value of the corporate debtor. I think Alokji elaborated about the two valuers to be appointed, who would be registered valuers, and registered valuers are those who are registered under the Companies Act, under Section 247 of the Companies Act. Now they are mandated to give values under two bases, and the two bases are fair valuation and liquidation value. We'll come to that a little more in detail, a little forward, but these are the two bases under which valuation has to be carried out. Now, the other thing is, what is the relevant date for the valuation? And the relevant date for valuation is the date of the relevant date is the relevant date of commencement of insolvency for the purpose of liquidation valuation. This is the valuation date which has to be considered for a valuer. Valuation date is very, very important. And as Alokji pointed out in one of his cases, where the value which was determined 3 years earlier also held after 3 years when the auction happened. This was a very interesting case, and I would say that shows that the value that was determined was a very fair and long-term value in the first place, and that has to be the intention of the valuation. I think Alokji has covered in detail about the Regulation 35, which deals with fair value and liquidation value. So I think I need not cover this much, but I just want to highlight this one aspect here, that the registered valuers who are appointed under Regulation 27, they have to determine the value following internationally accepted valuation standards after physical verification of inventory, fixed assets, or the corporate debtor. So physical verification of inventory and fixed assets of corporate debtor is on one side, which is on the process side. That valuation
Drushti ma'am? There is some network issue, so we'll request the speaker to take it forward. Due to network issues, she just logged out. So we'll wait for 2-3 minutes so that she joins. In the meantime, Alok sir, there is a question which is although very simple, but one member has asked, whether a chartered accountant can undertake IBC assignments.
He can say, as a chartered accountant, you can provide some services to the RP. There's no problem in providing service. There's no restriction in providing service.
He is asking a specific question, IBC assignment.
Yeah, IBC assignment. He can do an IBC assignment. No, he cannot become an RP. He has to first qualify. See, he
Exactly.
cannot. No. See, he can do some assignments for the RP if he wants, but he cannot become an RP. He needs to pass the qualification and register himself as a resolution professional with the IBBI.
Yes, sir. Ma'am is joining. She just dropped. There is some issue. She's joining again. I'll take another question. As the CIRP and liquidation process are two different situations, then why at the same time, at the time of CIRP, fair valuation and liquidation value, as on the date of insolvency commencement date, are taken from registered valuer?
Yes. See, at the as I said, that during CIRP you work out the fair value and liquidation value. Fair value is for a going concern. That means the company is still running, and liquidation value is when it is closed. So we have two values arrived during CIRP. Now, when you come under liquidation, you have 6 options of sale. You need to assess whether you want to stick to only the fair value and liquidation value. Firstly, fair value does not apply when you're in a liquidation stage. Now, if you say fair value does not apply totally, sorry, that's not correct. Because if your corporate debtor is maintained in the same situation, which was in CIRP when the fair value was determined, and you are selling the corporate debtor as a going concern, then there is a possibility that the fair value is relevant. But we generally do not arrive at fair value and liquidation value during liquidation process. We try to come to the valuation in those 6 circumstances shown in regulation 32A to F. So there is a change. So it is not correct to straight away adopt that value, which we have taken in CIRP. And in many times it is not acceptable. Okay.
Thank you, sir. Drishti ma'am could rejoin. Ma'am, you can carry forward the session.
Sure. I'm sorry, I had a network issue. I just suddenly dropped. So I'm just, again, I'll just share my screen. Just a minute, give me a second. Yeah. Okay. So, yeah. Right. So here are the valuation standards which need to be followed. So insofar as the insolvency process is concerned, it is very clearly stated that you have to follow the international valuation standards. And I was just elaborating when I dropped out that international valuation standards are basically what is contemporary methods of valuation, which are just codified. Now, when a valuer is registered under section 247 of the Companies Act, the registered valuer, that valuer has to also abide by the valuation rules which are specified under the Companies Act. Now, that says that till the time the company, the valuation rules, the valuation standards are not notified under the rules, till that time, the valuer needs to follow the valuation standards which are laid down by the RVO where he or she is registered, or he has to follow the international valuation standards, which means that for a person who's registered as a member of ICAI RVO, he will have to follow the valuations, also follow the valuation standards which are laid down by the ICAI, RVO, which are the valuation standards of the ICAI. Now, if you go to see, so somebody will say, oh my God, then there are so many standards to be followed, marrying so many things together will be difficult. But it is not the case. I would say that the international valuation standards and the ICAI valuation standards are more or less on the same lines, just a little bit of tweaking so as to adapt to the Indian situation is probably there in the Indian ICAI valuation standards. So this is one thing I just thought I must clarify this part because that can create little bit of confusion. Now, as I think Alokji has also elaborated that what are the situations under which valuation is required. So if we see the CIRP mechanism under that, under regulation 37, it says a resolution plan shall provide for has to provide for several things, and inter alia these are some of the things. So these are some of the things where valuation will definitely be required. One is the transfer of all or part of the assets of the corporate debtor to one or more persons, sale of all or part of the assets subject to security interest or not, restructuring of the corporate debtor by way of merger, amalgamation, demerger. That's another situation which definitely calls for, valuation. Substantial acquisition of shares of the corporate debtor, or merger consolidation of corporate debtor with one or more persons, cancellation, delisting of shares of the corporate debtor, or issuance of securities in exchange of claims. So these are some of the ways in which some of the situations which will definitely call for valuation from the registered valuer. Now next we come to the liquidation process regulation. Now under that, under regulation 32 that Alokji talked about, under regulation 32 there are several things which can be done by the liquidator to realize the value, and that is sell the asset on a standalone basis. Again, this requires valuation. Sell assets in a slump sale. When you say slump sale, means it is a collection of several assets and liabilities. Then you have a set of assets collectively, or assets in parcel. When you say slump sale, it's more of an undertaking which is that you are looking at. So there are certain judgments also in income tax which say, what is slump sale? Slump sale is when you have a single consideration for a collection of assets and liabilities which forms an undertaking, then it is a slump sale. So, but of course, this is IBC, but of course, when a particular term is not defined, it will take its meaning from the other statutes. And I think that's how we will have to interpret slump sale even under the liquidation process. Then assets in parcel is another way. Now we come to the most important and interesting provisions, which are corporate debtor as a going concern, or sell the business of the corporate debtor as a going concern. So this is a very important thing. You see, if one were to only look at liquidation value, which is just piecemeal valuation, or probably just the valuation of some of the assets taken collectively or in parcels, without assuming or without the presumption of continuity of existence, then there could be a I would say there could be a huge dent to the interest of the lenders, and because the value of the corporate debtor will not be maximized probably under this, unless the business itself is not viable. If the business is not viable, the going concern value is definitely going to give you a lower value than the piecemeal valuation that you will get under the other approaches. So going concern valuation, which are required, and or which are two methods of valuation under liquidation under 32, is very similar to a fair valuation, which is also on a going concern. But again, I will come to that a little later on under the various bases and premises of valuation, as to in which situation would you consider a going concern value, or even in a normal commercial transaction, it depends on what kind of a business or what kind of an asset you are valuing. That determines what is the right approach to be adopted for its valuation. So these are some of the areas where definitely valuation, which will trigger valuation from a registered valuer. Now, as we discussed earlier, what is required to be done by a registered valuer is that he has to give valuation under two main bases, and the two bases are liquidation valuation and the fair value. So both the values have to be given by the registered valuer. And so now the question arises as to whether he has to look at all these different scenarios and give different values under the different scenarios. I would say that considering the gravity of the role of a valuer in the entire process of liquidation, and maybe Alokji will be able to elaborate a little more on this, I feel that value ideally should be given under all the different scenarios, that is piecemeal valuation or a going concern valuation, and then that is the only way in which the COC can also take a call on what is the right way to go about. So again, sale as a going concern. So I think under 39C of CIRP, it is specified that firstly, the COC will, mandate that, the corporate debtor should be sold as a going concern, because ultimate aim of the entire process is to, continue the business and not just close down all the businesses. Because as we know, in the larger scheme of the things and in the economy, going concern is something which has to be sustained, because that generates a lot of economic activity, and if you don't have a going concern, the economic activity takes a big hit. So going concern is actually quite important from the larger perspective. Next, even under Regulation 32A of the liquidation process, you have sale as a going concern and liquidation, which we talked about under ENF of 32. So the recommendation has to come from the Committee of Creditors to sell under ENF of 32, or the liquidator has to form an opinion whether ENF will maximize the value for the corporate debtor. So if you see this, I feel it's quite important that the valuer has to give values under all the different situations. Only then I think somewhere the call can be taken in a very judicious way. A group of assets and liabilities of the corporate debtor to be sold as a going concern. Now, because when you say that something has to be sold as a going concern, a business or a company may have several set of businesses. There could be several segments. There could be several businesses. There can be several assets which may be disjunct. So one has to then identify what are those assets and liabilities which will form that undertaking which can be sold on a going concern. Now that has to be also identified by the COC, and if not so identified, then it has to be identified by the liquidator. Now, this is very important, because supposing somebody puts some other assets which are not really part of that undertaking in the entire, the hodgepodge of the undertaking, then even though that asset is not really contributing to the profit of that undertaking, and that is why that value is not getting captured as a going concern value, somewhere that value of that asset will be lost. I'll just give you a plain example. Say, for example, there is a factory, and next to the factory, there is a very large plot of land which the company had acquired, and they were looking at some sort of an expansion, but could not do that expansion, not for any legal reasons, but for maybe certain market reasons that they did not do the expansion. Now, when you do the going concern valuation of this undertaking, which is this factory manufacturing this particular product, you are not capturing anything, any value or the profit which is generated because of the plot, because the plot is a surplus asset. It is not put to use. Now, if in the valuation process, in this insolvency process, if this plot of land is also put into this, it's identified as forming part of this undertaking, and if the value of the undertaking is found on a going concern basis, then the lenders will lose on the value of this plot, which otherwise would have been added separately, because it's not really part of that going concern. So that just thought I just bring out this. Normally, when we do a valuation for a going concern under a fair valuation, we always find out what are the operating assets, what are the non-operating assets, and because whatever are the multiples or whatever you find, say the DCF or multiples, everything is only relating to the operating assets. This is a very important thing. Now I come to the valuation basis and the premises which have to be adopted. Now valuation bases are very clearly specified under the code and under the regulation. So the two valuation bases which have to be adopted are fair valuation and liquidation value. So that's it. You are not looking at a participant specific, value. So these are the two bases that you have. Under ICAI valuation standards 102, we have all these different values followed, and since we are looking at registered valuer, they have to not only just pull out some fair value just under one particular assumption, but they will have to do their assessment as a registered valuer. A registered valuer carries that burden on him. He has to take certain calls. It cannot be that he just does a mathematical exercise of just adding a few numbers or reducing a few numbers or finding some present value. It is not like that. You have to take several calls and you have to come to the value. So there are several premises also of valuation which the valuer has to look at. What are the different premises of valuation? So let's look at the first base, which is the fair valuation base. Now, fair valuation, normally one would say is, it's a going concern value. In most of the cases, yes. Maybe in some cases you may have, maybe an asset-based approach or a realizable or a replacement cost approach, which may be the fair value of the undertaking or the business. But now let us look at what are the different premises. It's very interesting. These are just, I've just stated here, but I'll elaborate with more examples. So let's look at the first premise of valuation. One is highest and best use. We are looking at the base of fair valuation, and under that we are looking at highest and best use. Now, I'll just give you an example, which is my favorite example always, that let's look at an asset which can be used in multiple ways. Say for example, there's a plot of land. A plot of land in say a city, in the heart of the city, if it is put to a particular use, it has an alternate use also. So for example, supposing there is a plot of land on which there was a hotel. Now that area is coming up, it's an upscale residential area which is coming up over there, and this is a hotel which is not really doing too well. It went into trouble, and that is why there's an IBC case over it. Now when you're looking at highest and best use, because you should look at that premise also, so when you look at that premise, you will be looking at the alternate use of that asset. That is that this plot will be then put to use, or that will be developed as a residential complex, an upscale residential complex. Of course, then one has to see what is the FSI available for that area and what would be the permitted user. Of course, the permissions will be required. Now if one were to go with the the narrow interpretations which may be drawn in some cases, that because that user was not available at the time, and when you are taking the presumption, you are going on the presumption that that will be the user, the asset will be put to, then you are actually kind of directing the authority that they will allow that user. That is not the way it should be looked at. It is one of the premise of valuation and should be, I think that alternate user should be considered very much for the purpose of valuation. So when we look at the highest and best use, in this case where there's a plot of land where there was a hotel which was constructed, and then that is because of various debt and the high leverage, that hotel is not used now. So we have to look at the highest and best use. So this is a very good case for highest and best use. Next we can look at is going concern, means highest and best use again in this case will be under the going concern value. It will not be under the it is not that the plot is going to be sold. It is just that it is you're looking at a going concern value under the highest and best use. Just give me a second. So the next one is, the other premise that we can look at is the as is where is value. Now the as is where is value for this same case, let's take the same example of the hotel. Now for the same hotel, the as is where is value is just the hotel. So if you are going to look at fair valuation for that hotel on an as is where is value, there are several approaches for valuing, say, a hotel property. You will look at which area it is located in, which city it is located in. There are also certain benchmarks which are there. Now these are very important, benchmarks. There are transaction multiples, and these the property per room value or something like that, which in turn will be based on what is the profit that one can generate per room of that hotel. So in such a case, one can look at even an as is where is value, but one has to also consider that to put that hotel back into use as a going concern, one will have to also put in some additional capex, because without that it is not possible to run the hotel, in which case that those outgoes also will have to be assumed. So a valuer's job is not just looking at this, okay, this is the hotel, I will just take that land and I will just see the building, the depreciated value of the building, the depreciated value of the fittings, and I will just give you the value. So that is one of the valuation under the liquidation value, but that is one of the values. That doesn't mean that the valuer can only give that value under the liquidation value and just get out of it, because that will be not fair on the corporate debtor and the lenders. Then we come to the other base, which is the liquidation value. So liquidation value also he's supposed to give. So under that also, if you see the premises of valuation, the premises of valuation again talk about the highest and best use under liquidation value. Again, that will go back to your going concern value, where you are looking at highest and best use of that asset. In the same case of that, say, the hotel, we can again come back to the same value under highest and best use, which will be under under 32 E and F, E or F, right? So one has to look at that. Going concern is the other premise. As is where is, as we discussed earlier. Then we have also the orderly liquidation or forced liquidation. That is where we will look at the piecemeal sale of the asset. Again, not necessarily when you are looking at again an orderly liquidation, the liquidation again requires that you look at value even as a going concern. So then whatever values you are finding under liquidation value, under the various presumptions, that is, you have a piecemeal sale, or you have sale of a bunch of assets together, or you have sale of the undertaking, or you have sale of the entire company, then you will again look at it under two premises. One is the orderly liquidation and the other is a forced liquidation. Now what is orderly liquidation? That is where there is adequate time which is given for marketing and liquidating the asset. So there's no hurry, so that it's not a distress sale. When you say orderly liquidation, it is not a distress sale. and a forced liquidation where you have limited time for marketing, and so you will have to let go certain, because if you are in a distress, you have to sell fast. In that case, you will have to give up some part of the value. You'll have to discount the value. So that is your forced liquidation value. So now let us look at valuation. So we discussed the various bases and the premises, but now let us look at the definition of fair value under the regulation. So under CIRP, what is fair value? Fair value is the estimated realizable value of the assets if they were to be sold at arm's length transaction, and the parties have acted knowledgeably, prudently, and without compulsion. So these are the presumptions which go along with the fair value under CIRP. Valuer has to be very careful, has to consider all these things, and then come up with the value. Supposing, for example, I'll just one example, because all this is theory. Without example, it will not make much sense. So when we say that parties had acted knowledgeably, so let's look at that. Supposing there's a plot of land which is under insolvent, which is owned by this company. It's a surplus plot, and if there has been in the recent past some transaction in that locality at a very good price for a similar user, plot with a similar user, and if the valuer has not considered that in his valuation, then there would be somewhere some sort of a lack of knowledge in this particular value, in this particular valuation. And there I would say that one can say that if the parties had acted knowledgeably, they would have considered all the transactions which have happened in the area at the fair value. So that's something that one has to keep in mind. It's very important. All these aspects have to be considered by the valuer. Next, we come to the definition of fair value under the valuation standards. Now, under valuation standards, there is valuation standard 101 and 102. Fair value is a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the valuation date. So as we discussed right at the start, for liquidation value, it is a liquidation commencement date which has to be taken as a valuation date. So one has to see the fair value which can be received on sale of the asset or paid for transfer of a liability in an orderly transaction between market participants as at valuation date. So I think this, although the wordings and the phrases would be differently placed, or the words would be different, but I think the meaning is very similar to the fair value definition under the CIRP. Now we go to the assumptions which are underlying the fair value. And fair value assumes that the price is negotiated in a free market. Okay, so that is, it's very important. If it is not a free market and there are certain other considerations because of which, you don't get the real price, then that is really not the fair value of the asset. Next, we have the other assumption is that this is very important assumption. Fair value reflects characteristics of an asset which are available to market participants in general, and do not consider advantages, disadvantages which are available or applicable only to particular participants. Now, this has to be really understood very clearly. When we say fair value reflects characteristics of an asset which are available to a market participants in general. I have an example a little later in this presentation where I talk about what is the meaning of, or what would you understand as the characteristics available to a market participant in general. But I'll give you here itself that example, that supposing there's a company which is highly levered and it has gone into debt problem, it's a debt trap and everything. Now that company obviously would have slipped to a very low rating, so you can understand that the borrowing also would be at a very high cost to that company, and there would be so many guarantees and securities, and despite that the cost of borrowing would be quite high to that company. Now if one were to value that asset, for a purpose of sale, then when you're looking at a sale or an acquisition by another market participant, that participant is not carrying this baggage, of heavy leverage, then should you not consider the market debt equity? Would you not consider the normal cost of borrowing which is available for this type of a sector in the market? And a normal, I would not say participant specific, I would not say that you should consider the rating of the acquirer, because until you know who the acquirer is, you cannot really come to a rating. You cannot come to exactly what will be the cost of borrowing, but at least what would be the reasonable cost of borrowing in the market is something that definitely one can consider. Because if one were to consider the same situation that the corporate debtor is in, then there would be no value to the asset as a going concern. So this is a very important principle which has to be taken cognizance of when we do the valuation. Next, we have price in principal and most advantageous market, which is used to measure the fair value, and it shall not be adjusted for transaction cost. That's where there's a difference between liquidation value. When you do a liquidation value, then you have to factor in even the transaction cost. But when you do a fair valuation, you don't have to adjust for the transaction cost. And to this end, the market in which the volume and the level of activity is high, or in which the realization from the asset is maximum, has to be considered. Okay, so these are some of the assumptions which underlie the fair valuation under the valuation standards, which have to be recognized by the valuer. Okay. Fine. Now, just a minute. Yeah. Okay. Now we come to the liquidation value. Now, what is the definition of liquidation value? The liquidation value under CIRP is the estimated realizable values of assets if the corporate debtor were to be liquidated. That is the definition under CIRP. Again, if you see CIRP, it takes you again to Regulation 32 of the Liquidation Process Regulation. So there is a clear alignment between CIRP and Liquidation Process value. And under Liquidation Process Regulation, the liquidation value is again the same, estimated realizable value of assets of the corporate debtor. The corporate debtor were to be liquidated on the insolvency commencement date. So the only thing is that one has to take cognizance of the insolvency commencement date. Now under ICAI valuation standards, let's see what is the meaning of liquidation value. So under the ICAI valuation standards, it is the amount that would be realized on sale of an asset or a group of assets, or when an actual or hypothetical termination of business is contemplated or assumed. And liquidation value can be carried out under the premises of orderly liquidation, as we discussed, or it can be under the post liquidation transaction with shortened marketing period. So these are the I think the facets of liquidation value which one has to keep in mind while doing the valuation under liquidation value. Now, when we look at understanding the premises, so we saw that there are several premises of valuation. Under fair valuation, you have the highest and best use, the going concern value, and the as is where is basis. We discussed with the example what is the meaning of highest and best use, and what is the difference between as is where is and highest and best use. But we'll just look at the theory which is underlying this premise. Highest and best use is a use of the asset that is physically possible, legally permissible, financially feasible. Now, if one were to look at this case, the earlier case which was cited, the Supreme Court had held, or basically there was an appeal to the Supreme Court that how can the lease be considered to be extended. But when it is legally permissible, I'm not saying that it is legally done, but if it is legally permissible to renew the lease, I think the presumption under the highest and best use to consider that the lease will be renewed is a fair assumption, because without that one cannot do a going concern value, is what I very firmly believe. And if we just look at that particular case, we can also understand that every city has demarcated areas. Certain areas are demarcated for schools, colleges, educational institutes. There are certain for government, buildings, for not-for-profit organizations, for the political, bodies. Also, there are certain areas which are for hospitals, also for sports. So once you have a particular area which is earmarked for a particular user, then the change of that user is a little, that itself is actually a more illegal activity than to say that the lease will be renewed. So I really feel that what is legally permissible can be presumed under the highest and best use value. Now, what is financially feasible? So that is also very, very important. Say, for example, if one was to just have, say, a water park in desert, like if you have a plot of land in an area which is absolutely starved of any water reserves, and then you say that, oh, this area has nothing, no recreational thing, and there are so many people, children, families, so one can always have a water park here and people will come in swarms. So people, but will it be financially feasible? So that's an example. Like maybe it may not be financially feasible to have that kind of a setup over there, because the people would not be economically prosperous also over there, because historically it is seen that where you have more water resources, those areas have always grown, and then the history just carries on and it just builds on itself. So that's where I think one has to have that depth in analysis. One cannot just look at something in isolation. One has to understand in greater depth the entire situation. So financial feasibility is also very important to take the highest and best use value. Then entity's current use of non-financial asset is presumed to be its highest and best use, unless the market or other factors suggest that a different use by market participants would maximize the value of the asset. So this is a presumption that one would assume that this would be the highest and best use, unless there are other factors. And if there are very glaring other factors which are present in the circumstance, then one should consider the alternate highest and best use also. Otherwise there is a lack of, I think, proper perspective built around the valuation. Next, we have the going concern value. So obviously this highest and best use also, it can be in a piecemeal. When we go into the theory of value and we go into the debate in valuation, one can say that highest and best use can also be in a piecemeal. Yes, it can be in a piecemeal also, piecemeal distribution, piecemeal sale also. But say if one were to consider the going concern value, then highest and best use married with going concern value will give you a different value altogether. A piecemeal sale with considering highest and best use will again give you a very different value. But again, when there's a going concern, you are looking at different risks and rewards, and there will be different costs attached to it. So all these things go into your cost of capital, it goes into your cost, your leverage. It's a very, very holistic exercise that one has to undertake. It cannot be a shallow thing which can be taken up. So next you have obviously the going concern premise, which assumes that all the business will continue, or in the highest and best use of the asset, the going concern presumption can be considered. Also, intangible assets also will have to be considered. Now, I'll just elaborate a little bit on this intangible elements in a going concern. Recently, in case of IBC only, I think there is one judgment where, for the first time, NCLT, just a minute, has the court has said that this value cannot hold because it doesn't consider the values of the intangibles which are part of this undertaking. So the value, so then the direction is that also find out the values of these intangibles attached to this pharma business. Now, when you are doing a going concern value, you will probably be going with the profitability, you will be going with the earnings. Now, when you say earnings, you would probably take the current earnings with certain growth, and you will take a yield approach, or you will take the future cash flows if you have the future cash flows, or if it is possible to build future cash flows. Now, when you say that this is going to be my cash flows going forward, considering this business, in that case you are not only already considering in that value the values of the operating assets, but also all the intangible assets. So not only the tangible operating assets, but also the intangible operating assets are also considered in that going concern value. This is very important to understand. It is not that when you find a value under DCF, it is just value for the tangible assets, and intangibles have to be valued over and above that, or that the value that you find under DCF or the earnings method is only the value for the intangible, and the tangible, all the operating assets also have to be added on top of that. That is a wrong way of valuation, because when it is a double counting, either you take an asset as an operating asset and include that in your going concern value, or you don't take it in your operating assets and you take it in a piecemeal. You can't also take it in your operating assets in going concern, and also on top of that add it in the piecemeal value. So that is about going concern value. Next, you have the as is, where is, so that, as I discussed, that if there is a particular user of a particular asset, and if that use is not really, maybe not the highest and best use, but that is also another premise. So you can specify that under an as is, where is basis of valuation, this is your value. So when you get a valuation where you have to do fair valuation and liquidation value, you will do fair value, liquidation value after considering all the various scenarios which are specified in the regulations, and also after considering all these premises of valuation which one should, because that is the holistic value of the asset. Now we come to the valuation approaches, because till now we discussed the theory around various values and the premises and the basis. Now let's look at what are the valuation approaches. So these are some of the approaches that we adopt for fair valuation, going concern valuation. Also, it is not necessary just going concern. For example, say you have a comparable transaction for a plot of land, that will fall under the market approach, and that would probably go under the piecemeal valuation. It is just an asset sale value, but it is a market approach. So all the valuations that you do will fall under some one or the other approach of valuation, which are covered under the valuation standards. So let's look at the first one, which is the income approach. Under that we have the discounted cash flow method, which we typically use for a going concern, whether highest and best use, or under a as is, where is approach also. So you have the DCF, which is a typical going concern valuation approach. You have yield capitalization also, which is also in a way nothing but finding out the perpetuity value in 0 year itself, which is what you do in DCF in the last projected year. So in a yield capitalization approach, you are doing the same thing. And here you will resume certain growth, because it is possible that you will not have the cash flows for the asset that you are valuing. If you don't have the cash flow for the asset that you are valuing, you will And if you want to do a capitalization of profits approach, the best way to look at it is, why don't you, find out the yield capitalization. So you have the profits which is normally generated on that asset. So you will take that profit and then you will do a capitalization. You take certain growth also into account, looking at various factors like the risk-free rate, the inflation, the growth trajectory of that particular line of business. So you'll consider all these things, and then you will take a capitalization of profits, in the 0 year. That's also income approach, because it is not a market approach. It doesn't take any market multiple. It is purely based on profits, the cost of funds, the growth. So it falls under income approach. So that's the going concern value. Next we come to the market value approach. Now under market value approach, we have obviously the market price method. Now when you're looking at say sale of shares, and under market price method, you will have to look at the market price in the market where the maximum volume is being traded. So that's where the premise of valuation comes in, where you have under the fair valuation, the assumption, which is that it is the fair value is taken in the market where there is maximum trade or maximum demand for that particular asset. So when you look at market price of say shares, you will probably take the market price in the market where the maximum trading of the share is happening. Next you have the multiple based method also. Now the multiples are derived from the market traded shares, or traded multiples for that particular business. So you can apply that multiple to your base. Now that base can be the earnings, that is your profits. It can be your asset, depending on what exactly is your sector and the nature of the asset that you are valuing. Different assets will require different types of multiples to be used, because it may not be right. For example, say if you are valuing a lending business, and maybe you will be guided more with the price to book multiple, because that's where, although you will factor in somewhere the profitability, the net income margin and everything, and the NPA also, but you will have to consider the price. You will have to give some cognizance to price to book multiple. So there you will not take an EBITDA multiple. It is useless to take an EBITDA multiple, because lending business. So EBITDA is not the right yardstick, a proper benchmark to consider. So anyway, so one has to see what exactly you are valuing, and based on the asset that you are valuing, you will have to be judicious in taking the right multiple. Then you have the comparable transaction multiple approach. Now under comparable transaction multiple, as I discussed, some time back in some earlier slide, that maybe there's a transaction which has happened in the vicinity for a plot of a similar, user. Then you may even consider that comparable transactions multiple for, for 1 acre, what is the price which is exchanged. Now, comparable transaction is also in terms of, the business also, even as a going concern. So say for example, if there is, I'll just take you back to the hotel example. Say for example, if there are transactions which have happened in the space for say hotels, and for that particular area, certain hotel properties are exchanged at a certain multiple per room, then you will have to also consider that comparable transaction, multiple into your valuation. So this is, and there are so many different yardsticks which have to be considered for the different types of operations. Say for cement, you will have a different comparable transaction multiple. You'll have it's a very interesting field that one gets into when we look at the comparable transaction multiples. Next we have the cost approach. Now total property valuation on an as-is where-is basis. It's a going concern value, but it's an as-is where-is basis. That then not only you can consider the cash flow approach, but you can also look at the replacement cost approach, right? That is, anybody who is taking over that asset will be willing to pay, the replacement cost of that, asset, because if he was to set up that particular asset to use it in that particular fashion, say in that hotel, then he will have to incur that kind of expense for putting up that property, for putting up the fixtures. But of course, that depreciation, the obsolescence, everything will have to be considered. So that replacement cost approach is also a going concern value, you know. Then we have the liquidation method, where we see the realizable value of the various assets after reducing the cost of liquidation. So that is the liquidation method under the cost.
Ma'am, it's already, we are reaching like
5 o'clock, right? Yeah.
Yeah.
Okay. So, okay. So then, if you want me to, this is the last slide before the case study. So I can just.
Yeah, sure, ma'am.
Okay. Okay.
No problem.
Yeah. Okay. So now, okay. So I just take the case study instead of that last slide because I've dwelled on that interdependence. So let's just look at this case study, which I have here. So again, it's just the same thing. It's just a kind of a recap of we discussed this one particular case where there's a hotel building. So what is the highest and best use? And here what I want to just bring out is just these 3 questions, that whether the borrowing cost will be considered for the valuation, should it be the market rate or the entity specific rate? And I think I have already given you the answer for this also, that in such a case, when it is, you should look at probably the borrowing cost which is in the market, which is prevailing in the market. The next is what would be the level of leverage, again, because the buyer would not have the baggage of the seller, so one should take the normal level of leverage which is there in the market for this kind of an asset, say whatever 60-40, 70-30, 80-20, whatever is the normal leverage prevailing in the market can be considered for the asset. And the third, obviously most important, is the working capital, that in case of a stress working capital, but when you're looking at selling it as a going concern, you will take it at the normal level of working capital and not at that stress level of working capital. So these are some of the things, which platform. I will not dwell upon the already talked about. And with this, I would like to end my presentation. And thank you very much, Tarika ji and Rita ji and Mangesh ji, for giving me this opportunity. And also, Durgesh bhai also, I can't see him, but definitely thank you very much for this excellent, session that you planned.
Thank you, Drushti ji, for your excellent deliberations. And I think Alok ji is also here. We have just touched and crossed the time limit, which is set and given by vendors. So, and questions also, I think a couple of questions which were asked during the session only have been answered. And in fact, certain questions Drushti ji has answered in her presentation also. So I think there are no questions also. In fact, I would specifically like to thank Drushti ji for dwelling upon the valuation standards and touching upon and emphasizing on the importance of valuation standards also. So on behalf of Valuation Standard Board and as well as Insolvency and Bankruptcy Code Committee, I'm proposing the hearty vote of thanks to Alok Saxena ji and Drushti Desai ji for dealing with this topic very nicely. In fact, we would have loved to see your last listing on case laws, but definitely we'll have some more session on specifically design and would like to listen to you from practical examples also in the coming future. And since you have done very important valuations very recently, we would like to listen from you regarding some practical insights and practical case laws on valuation. So Alok ji, you have also done great justice to the subject, and on behalf of both the committees and ICAI, I thank both the I can say speakers from my western region. So thank you very much for that, and we would definitely love to listen to you more, keeping more such practical session. I'm very happy to announce that this session also has been attended by around 3,000 people throughout the country, and that in fact emphasizes the importance and of this session. And very good responses we have received on email from the members. So thanks a lot to both of you for sparing your valuable time and dealing with this topic very nicely and making full justice to whatever has been taught by both the committees. So thank you very much. And I also appreciate the efforts taken by Sarika ji and Rita ji from both the committees secretaries for this session. And definitely, friends, will be happy in taking some more such sessions during the year with such eminent faculties. In fact, we will be having Drishti as a coopted member also in Valuation Standard Course. We'll have more ideas from her regarding more such sessions to be taken. So thank you very much to all for joining this and making this webinar successful. Thanks a lot.
Thank you so much, sir. Thank you so much. Thank you,
Thank you.
Drishti ma'am.
Thank you,
Thank you,
Drishti.
Alok.
Thank you.
Thank you,
It was a
Alok ji.
pleasure.
Thank you, Mangesh ji.
Yeah.
Bye.
Bye.